Good morning from London. I'm Anna Edwards alongside Tom McKenzie. We're an hour away from the opening trade. Here's what you need to know. Soft US data sparks a global stock sell-off, with European and US futures now pointing lower. Treasuries gained for a seventh straight day ahead of today's jobs report. Tech troubles. Intel plummets as much as 19% as sales slump, while Amazon tumbles on its plan to increase AI spending. We'll bring you details along with the latest from Apple. Plus, President Biden vows to provide Israel with more military support as the country faces new threats of retaliation after the killing of top Hamas and Hezbollah leaders.
Let's check in on these markets then. Brace yourselves for a challenging day across these markets. The downside, of course, coming through yesterday on the US and in that session. The handover to Asia, where it's been brutal, and frankly, the setup for the European session this Friday then looking very ugly indeed. Currently, European futures pointing lower by a full percentage point. As Anna was saying, tech crumbling, expectations that the Fed is going to have to go deeper in terms of its cuts given the weakness in the economic data out of the US. The work being done in the Treasury market then, the 2-year at 4.12, 7 straight days of gains, and the yield now on the 2-year the lowest in about 14 months. The Bloomberg dollar index currently down 0.1%. Brent in focus as well, given the continued concerns around the geopolitical risks in the Middle East. Still above $80 a barrel, up 0.9% so far in the session. The countdown to the opening trade starts right now.
Welcome to the programme, everybody. It's just gone 7:01 here in London, and we have plenty to talk about this morning. As Tom was setting out there, negativity around risk assets, negativity around stocks, appetite for treasuries, all of that worth discussing. Geopolitical risk as well, something keeping very firmly on our radar as we approach the weekend. Tom, let's start the conversation then about the broad market sell-off we've seen, the things that have provoked it, and then that will take us into another conversation about tech, won't it? But we've seen this stock sell-off really gaining pace, gaining momentum through the Asia session. Obviously, the yen and the BOJ is a slightly separate case, but it's not just Japan that's falling. But the Japanese market is really weak. The Topix index closing 6.1% lower, the biggest drop since 2016. So we're starting to get comparisons that take us back pre-COVID. What is sparking this? Well, there's a host of reasons. Tech we'll come to in a moment. We also have to factor in the weakness in the US data. The ISM and the manufacturing ISM employment component dropping to 43.4, really giving the market pause for thought.
Yeah, the details within the manufacturing gauge really significant around the employment component, as you say, and just the fact that broadly it contracted for the most, the biggest drop in about 8 months. It's a number of these factors then coming together that's really weighing on Japan, and then we'll move it out and broaden out because some of these stories link across to Europe and the US, of course, as well. For Japan, it's the strength of the yen once again. Don't forget, the context is that Japanese equities have been the darling of many an analyst out there and fund manager out there earlier this year, now taking a big hit on the back of the fact that tech is falling away. The economic data in the US is looking softer, and the Japanese yen and the strength, yes, we're talking about strength of the Japanese yen, is a concern for that part of the market.
And the Japanese Topix entering correction then, falling 13% from its July peak in the wake of all of that appetite for Japanese assets. We set that market backdrop up knowing that we've got more data on jobs later on today, which is important. Given that there was that disappointment around the employment component of the ISM, we then roll things through and think about payrolls. More on that later, but we are expecting 175,000 jobs to be created there. Let's talk about tech because, again, some warning signals, in particular from Intel, stood out to me.
I mean, Intel was absolutely was the standout. So they've cut their dividend. They've suspended their dividend at Intel for the first time. They've been running a dividend at this business since 1992. So they suspend the dividend. The challenge is going forward as well. It wasn't just this quarter. It was the projections out for Intel, the softness that they expect. This is a reminder that a company that has failed to catch up with the AI boom is suffering as a response. AMD, Nvidia eating much of their lunch. And the stock fell at one point down 19%. And the CEO, of course, Pat Gelsinger, talking about having no illusions that the path in front of us will be easy. It was a real shocker from Intel. Amazon reminding us that they are going to continue to spend on AI. The e-commerce part of the business looking a little softer. Cloud did come through. AWS was a positive for Amazon. Apple, by the way, looking forward as well and saying that their AI story will start to come to play in terms of shipments of iPhones. That's going to be a lift for them. But a little bit mixed, particularly when it comes to the China story for Apple.
Yeah, absolutely. The China story a bit mixed, although they did say that if you stripped out, well, that a lot of it was the dollar strength that was giving them headaches there, and actually the underlying market not so bad. But waiting for Apple Intelligence and the upgrade cycle there will be interesting. So more on the tech sector as we go through the programme. Let's pivot to the Middle East and some of the thinking and the latest news flow coming out there. President Biden's promising Netanyahu new defensive US military deployments. Not exactly clear what that means or when that means, but given the threats that we've seen to Israel over recent days, it's important to emphasise that has been the commitment from the US government. Really interesting that Biden and team have been using intermediaries to send warnings to Iran, to Hezbollah, to the Houthi rebels over in Yemen as well. And some people making quite a lot of the fact that the Hezbollah leader Nasrallah has been talking about how the killings of these leaders of Hamas and Hezbollah have crossed a red line, but not declaring war in so many words. Whether that's comfort enough for those in Israel, we'll have to wait to see how the weekend develops. In terms of market response, oil is focused on the demand story, it would seem, even if oil prices are pushing up a little this morning.
$80 a barrel on Brent. And to your point, Hezbollah, the most significant risk in terms of the different proxies linked to Iran. That is the assessment, of course. And so the fact that they seem to be calibrating possibly some glimmer of hope there. But certainly this is a region that remains very, very tense indeed. And the Biden administration, as you say, trying to play that dual role of pressuring Israel to continue the talks around the ceasefire around Gaza, but at the same time saying we have your back if you are attacked. And
we will have more analysis on this subject, certainly, as we go through the programme. Let us tell you more about what is coming up on today's programme. At 7:15 UK time, we will speak to Yael Selfin, Chief Economist at KPMG. We'll talk about the UK, the Bank of England, cutting interest rates. That's an important story we need to mark. We'll do that. At 8 o'clock, we'll be joined by Jeffrey Yu, Senior EMEA Market Strategist at BNY. Then at 7:30, we'll speak exclusively with Andy Briggs, Chief Executive of Phoenix Group. And at 8:45, we will discuss the latest developments in the Middle East. We'll be joined by Jane Kinnenmott, Policy Director at the European Leadership Network.
Yes, some really good names to work through some of these topics and, of course, what is happening on a really challenging day for these markets. Here's what else to be thinking about then today, this Friday. 1:30 p.m. UK time, we flagged this, the US jobs data, the payrolls and unemployment rate. Unemployment expected to remain at 4.1%. Interestingly, Bloomberg Economics has unemployment in the US rising to 4.5% by the end of the year. But, of course, given the jobless claims and the tick-up that we saw yesterday, this is really important. This is the data set of the day in terms of getting a gauge as to the health of that labour market in the US and expectations around the Fed as markets price in more than 25 basis points in terms of the cut coming through for September, the expectation. 3 p.m. UK time, US factory orders after the softness that we saw in manufacturing. That's going to be important, and durable goods. And later in the energy space, as we talk about higher oil, Exxon and Chevron coming through with earnings after the beats that we've seen, of course, for BP and Shell in this part of the world.
Let's go through some of the other stories that we need to keep on the radar this morning. President Joe Biden and Vice President Kamala Harris have welcomed home US prisoners freed in a major exchange between Russia and the West. Moscow released former Marine Paul Whelan, Wall Street Journal reporter Evan Gershkovich, as well as jailed Kremlin critics. In return, Russian prisoners were freed, including a convicted assassin sought by President Vladimir Putin. The US Secretary of State says Venezuelan opposition candidate Edmundo Gonzalez won the most votes in last weekend's disputed presidential elections. Anthony Blinken says there is no evidence supporting the victory declaration of current President Nicolas Maduro. Opposition leader Maria Corina Machado is calling for nationwide demonstrations this weekend. An advisor to China's PBOC has issued a rare critique of Beijing's economic policies for being overly conservative, urging the government to ramp up fiscal stimulus and promote inflation. The prominent Chinese economist says the policy concept of, quote, focusing on investment and neglecting consumption should be changed. China's economy has struggled recently with growth unexpectedly slowing to its worst pace in 5 quarters. And this is an interesting story, Tom, in terms of the China growth story, because, yes, we've focused a lot on China's wanting to encourage consumption over recent years, but that has not necessarily been the policy priority of late. And interesting to see this PBOC advisor then talking about an inflation target range of 2 to 3%, suggesting we need to almost get to a kind of minimum inflation goal rather than just seeing high inflation as undesirable.
Because essentially inflation has been flatlined in China for months, and that is a very different story, of course, to what we're seeing here in the West. But let me put the context in terms of what we're hearing from Huang Yiping, who, as you say, is this advisor. He's on the Monetary Policy Committee of the PBOC. To put your head above the parapet and offer a critique in this environment of China right now is saying something. It talks to the urgency that's being felt by senior officials and advisors. And so what he's saying is there needs to be a doubling down in terms of support, more support for the consumer, in terms of cash handouts and getting migrant workers, allowing them to work and live in cities, which right now is very difficult. So he's critiquing the current policy measures, and that's not something you hear very, very much now in a China where, of course, speech around these issues has been considerably constrained. So I think it's really notable.
Yes, and we've certainly seen a lot of international investor disappointment at what came out of the plenum, as evidenced by weakness in certainly Chinese stocks, although that being joined by a pretty global sell-off right now for other reasons. Let's talk about some of the other things coming up during our programme today. Coming up, the French insurer AXA is in talks to sell its asset management unit to BNP Paribas for 5.1 billion euros. We will go live to Paris for the latest. Plus, we'll take a deeper dive into tech earnings and discuss headwinds facing the sector following a largely disappointing reporting season so far. Those news lines coming through on the chip sector from the US yesterday really rattling a few nerves. Up next, the BOE's easing cycle has started. We will bring you some of our interview with the Governor Andrew Bailey and analysis with Yael Selfin, Chief Economist at KPMG. If you have questions for our guests, we'd like to hear from you. IB plus BBTV Go is the function to use on your Bloomberg terminal. This is Bloomberg.
We were looking for, in a sense, for sort of confirmatory evidence. We weren't looking for something to change necessarily. It was confirmatory evidence. We had that. I think we had, certainly in my own view, we had that. But we will be looking at this framework and saying, are we seeing this sort of rather more benign process which we can sort of further confirm? Or does this sort of structural issue, which is why we've put this sort of risk in, that maybe COVID, for instance, has changed some elements of the structure of the economy, which is going to make the thing more sort of resistant, if you like, to measures to get inflation down. And that's the judgment we will have to keep coming back to.
That was the Bank of England Governor Andrew Bailey on the central bank's decision to cut rates. Let's talk about the UK economy and then widen our conversation. Yael Selfin joins us, Chief Economist at KPMG UK. Nice to speak to you this morning. Thank you very much for joining us. There was quite a lot of talk yesterday from the Bank of England and from their press conference about this framework for thinking about how quickly inflation can keep coming down from here, whether we're really in an economy that's very different post-COVID, whether things have structurally changed that means the economy responds differently to interest rate moves. What was your takeaway from what we heard from the Bank of England on that front yesterday?
Well, my takeaway was that things are finely balanced at the moment. It's difficult to say whether we are seeing a gradual and continuous decline in inflation or whether the consistency or the persistence of inflation, especially when you look at the core and service sector inflation, whether that is likely to remain and potentially deteriorate now that we know already that inflation is going to pick up a little bit later on this year. So I think that is the main concern there.
I think it's interesting also to think about where the wages story goes in that services context, because Andrew Bailey yesterday was showing a chart of inflation perceptions. And this is not expectations of the future. This is just where people in the country think inflation is right now. And it's somewhere around 6%, which is not where inflation is. That's the sort of the long shadow that inflation has cast over the public psyche, I suppose. And that in itself, especially if inflation does tick up from where it is around 2, we could see upward momentum on or upward wage demands at least.
True, to some degree, although I'd say it is fair to say that expectation, especially when you look at household, could be backward-looking. It's quite likely they will be backward-looking, and therefore that deceleration, which is what he was saying as well, is expected to take a little bit more time. So I wouldn't worry about it too much, especially when you look at the longer-term expectations. They remain relatively well anchored.
I'm still not convinced. I need clarity as to where that inflation would come from in the UK. I mean, we have growth of less than 1% this year, a little over 1% next year. The jobless rate is going up. The global economy is looking pretty soft. We've got concerns now that the Fed is behind the curve. Where does this inflation come from? We're at 2% on the headline for the UK. Why don't they go again to set the course for lower rates in the UK?
Well, there's a number of things. One is that when you look at core inflation, when you look at domestic generated inflation, service sector inflation, they haven't gone down by that much. Then
there's a lot of volatility there, though. I mean, airlines are saying to us that airfares are having to go down. I mean, UK consumers are feeling the pinch still.
Absolutely. There's certain elements there that are very volatile, and when you strike that out, inflation is relatively better. Well, it is better behaved, but we know inflation is going to go up anyway just because of the energy prices coming out of the equation, if you like. So headline inflation is likely to go up and will be above target again until sometime next year. That is psychologically, that is probably the wrong direction, and the implication for businesses is when they are tight, whether they're going to see that as a potential rise again, or whether they'll just take it at face value. Well, it's just a little bit of a bump and we're going back.
And I mean, the market is with you, Tom, to the extent that as a result of all of this, the pound fell and the market priced in more cuts, didn't it? Even though we did see the Bank of England suggesting that there could be upside risk to inflation in the shorter term, to Yael's point, that the longer term direction that they were flagging on inflation is one that comes down by 25, 26, below their target, below 2%. So there does seem to be that the market is assuming that we do get more rate cuts.
Market's pricing in more cuts. Bailey's saying, look, we're going to still take it meeting by meeting. We'll look at the data and we'll still be data dependent. But as you think about what's happening with the Fed and the data that we're seeing in the Eurozone as well, and the fact that China's not kicking in, all of that comes together and looks like a softer economic environment. But we do have those challenges around energy. I accept that.
We had stronger data in the UK. So actually the UK economy was stronger in the first half than what we had expected and the bank expected. The banking is now thinking that it will moderate, but we have to wait and see. We've got a relatively strong mandate for a new government that could push stronger growth due to, well, better investment, less uncertainty. But then generally, I absolutely agree with you, longer term, when you look at 3 years ahead, inflation is below target, and that is really what the bank should be targeting.
Yes, I think you mentioned the new government there, and that's an interesting one, isn't it? Because not everything we've heard from the new government about their plans is reflected in what the Bank of England is assuming here, or hardly any of it. Because, yes, they were briefed by Treasury officials on the impact of the higher wages for certain public sector workers, but there's going to be a host of other policy announcements that, until they're presented officially in a budget, the Bank of England simply doesn't factor into its thinking, does it?
Yeah, and I agree with Bailey's assessment that the rise in public sector pay will not have a major impact on wage or inflation. But we don't know really the plans yet. We have to wait for the autumn. We have a date now for the autumn statement. And therefore, when you think of when it will actually be factored in, there's still 1 or 2 more meetings where they won't have that data.
In terms of, before we move on to the US, because we're going to get your thoughts on that as well, particularly given how markets seem to be reassessing the Fed and its decision, particularly in the light of the softer data we got out stateside yesterday. Before we get there, in terms of the sequencing then from the BOE going forward, and Anna pointed out the markets are now pricing in about another 40 basis points of cuts by the end of this year. How do you see the sequencing pushing into 2025? Where do you see rates by the end of next year?
It's a very good question. Initially, we thought the cuts would be fairly swift and we would have a cut every meeting, because once they start cutting, there's really no reason why you wouldn't go back to neutral or near neutral rate. Now we're thinking, given that the balance is so fine, they would probably want to wait a little bit more. So we're expecting just 1 more cut this year, potentially at this stage, based on where we see the members at this stage. It's not necessarily what I would do personally. I think there's probably a bit more room to cut than that. And then it may be also more gradual. So perhaps every other meeting, or once they publish an inflation report, so to coincide with that.
Let me go to the US then in our thinking, because we do see risk aversion across a lot of markets this morning. We see a lot of appetite for treasuries and fixed income. We see US futures lower, NASDAQ futures, yes, there's the tech earnings story, but down by 1.5%. Asian equities really struggling, Japanese in particular. Yes, there's the yen effect there. Looking at one of the pieces by our colleague John Authors, he just sums it up as saying markets are back to worrying about a hard landing and a mistake from the Fed. What do you think that sums up what markets are worrying about right now?
Well, I think the evidence on the labour market is a little bit mixed. So even though you have headlines numbers that may be a little bit worrying, you need to bear in mind that you had other circumstances. You had still the recovery from the pandemic that makes things a little bit more unusual. You had fairly strong immigration coming in that would potentially raise the unemployment rate a little bit and makes the labour market generally a little bit more loose. So I think it is finely balanced, and that's really what the Fed called in terms of where we are. The risks are equally on waiting too long or cutting too early in that sense.
And so are you worried about a hard landing in the US then?
Well, I think there's so many unknown with the US economy at this stage in terms of policy that we will only find out later on this year. So in that sense, there is quite a lot of uncertainty beyond the fundamental economics.
Does that suggest you're going to need to wait beyond September then to get clarity as to whether or not this is an economy now heading into a more challenging scenario, whether this is a recession that is in the cards later this year for the US? What are you watching for specifically to be able to make that call?
Well, definitely the labour market, and the figures later on today will be helpful. Sorry. But I think we do need to wait for at least another, for at least another month or so to see how things evolve with inflation figures, with how the Fed is reacting, as well as with things like real estate.
Do you think, before we let you go, do 3 cuts from the Fed, does that seem reasonable? That's what the market's are pricing in now, a little over 3 cuts this year.
So our economists are expecting two cuts this year, one in September, one potentially in December, or if things are worse than that, in November.
Yeah, thank you very much. Thanks for joining us, Yael Selfin, Chief Economist at KPMG UK. Interesting, we're talking about where the US economy goes, and there's so many unknowns, and one of those, of course, is around the US election. Interesting polling data taking us into an interesting conversation about where the Trump trades go from here as we follow the polling.
Yeah, and so the Trump trade involved betting on Bitcoin. It involved the yields steepener, so expectations that a more generous fiscal policy or a fiscal expansion from a potential Trump administration would push up yields and see a sell-off at the back end of the Treasury curve. Some of that is being unwound right now, and it's a reminder of how challenging it is to put your pin in the political narrative, or at least how politics evolves. And I think Yael was nodding to that in terms of the policy uncertainty of the US. So that Trump trade, at least on many areas, has started to fizzle right now. And some of that is down to the polling, some of that's down to the Fed.
Yeah, the bond rally, the stalled dollar suggesting an easing of those Trump-related bets then, perhaps. Interesting, though, is we've got a great story that goes through all the different asset classes and what the Trump trade could have looked like and what it might look like if it returns, but then asks questions about what a Harris trade looks like, and it's not entirely clear other than some continuity in there, of course. But, yeah, we'd have to dig into that one in a bit more detail. We are going to talk about investments a little more in the UK.
New investment management firm seeking to deploy billions of pounds in private assets on behalf of British pensioners. We're going to speak to Andy Briggs, Group CEO of Phoenix, who's spearheading this initial allocation. That is next. This is Bloomberg.
Welcome back to the opening trade. 30 minutes until we get that opening trade here in Europe. And here is a look at the markets for you. The futures picture looks weaker. No surprise there, given what we saw yesterday in the United States. Nasdaq down by more than 1% by the close. And then we had some after-hours tech news that disappointed. In session, we've been led lower by fears around the US economy and the growth, the job story there, the job creation story. We'll get more details on that, of course, as we go into the session today, because we get the non-farm payrolls report. But this is how that and translates through an Asia session where the topics was really weak, and Asia markets, including Japan but not limited to, were really weak. That rolls into Europe with Euro Stoxx 50 futures down by 1.3%. So we are expecting weakness. And the opposite trade to that, if you like, is a move into bond markets. We are seeing enthusiasm for bond markets rolling into its 7th day, certainly on treasuries. If I look across what's going on in European bond markets right now, it does seem to be that we are buying a bit of German debt this morning, and those yields coming down just a touch, but we are selling some Italian and Spanish debt. Not huge moves, but we'll watch these bond markets to see where they take us. Let us talk about the private investment market here in the UK. Phoenix Group, the UK's largest long-term savings and retirement business, and asset manager Schroders have this week agreed to establish a private market investment vehicle for UK pensioners. The new entity aims to invest £10 to £20 billion over the next decade. It comes on the back of the UK's push for pension plans to deploy more of their capital in a way that boosts Britain's economy. Lots to talk about then with Andy Briggs, who's the Group Chief Executive of Phoenix. And we're pleased to say he joins us on the programme. Andy, very nice to have you with us this Friday. So this venture takes you into then private markets, launching this new private markets investment vehicle. Tell us what takes you there. What are the types of private assets that you want to put money to work in that pensioners, that investors in the UK are not getting sufficient access to at this point?
Sure. So good morning, Anna. And so Future Growth Capital's a new asset management business we're setting up as a joint venture with Schroders, focused on UK and global private markets, private assets. And from a customer perspective, that's the primary reason we're doing this. We believe that by allocating 5% of our customers' money to private assets, we'll deliver them better returns over the long term and give them a better retirement. And it's something the UK has not been good at historically. And therefore, UK savers have underperformed in terms of the returns they've got relative to their international counterparts. In terms of the types of areas we're investing, what's really important here is to have a very diversified range of investments. We wouldn't want one of our customers' 5% allocation to private markets to be on a single private market investment that could go 10x, could go to nothing. So we want to invest across a very broad range of sectors and a very broad range of vintages of different stages of investment in markets, so that customers get a very diversified return as a result.
OK, it's interesting you said that. So it's a UK and a global private markets fund. What will dictate how much of this goes into the UK? Because you've obviously been very supportive of all the Mansion House initiatives that are trying to put more money into UK assets. And so how much will go into the UK, and what parameters will be set around that in case you decide that actually the UK isn't the best place to put the money in any particular instance?
Yeah, so we fully expect this to have a strong bias to the UK. And the reason for that is that the UK has fantastic opportunities in this space. So we have 4 of the top 10 universities globally. They have fantastic startups and new ideas, but British savers don't get the opportunity to provide the capital to scale those. It's very often international savers that get the opportunity to do that. So we want our customers to have the benefit of backing those brilliant university ideas as an example, as they flourish and grow. But ultimately, it is important there's a diversified range of investments, and we will always allocate our customers' money in the way we think will get them the best return. But we think there's a real opportunity for a win-win here. We get better returns for our customers, and we really stimulate and drive economic growth in the UK.
Andy, good morning. It's interesting you bring up the universities, because you're absolutely right. There's a lot of really interesting spin-outs coming through from some of the higher learning institutions here in the UK. One of the critiques is that they demand a big equity stake, and they don't let. There's not enough flexibility there in terms of other investors coming on board, and for the men and women at the top of these businesses to be able to expand and grow and be able to carve out beyond the universities. Is that something you want to see change? Is that equity holding that's very different to the US, where it's much more thriving in terms of the spin-outs from unis?
So my observation would be that lots of the businesses coming out of universities are getting scaled and are getting equity injected in them as part of that scaling, but it's overseas savers that are getting the opportunity to do that. It's the Canadian pension funds, it's Silicon Valley, it's the Australian super pension funds, rather than the UK savers. So what you say, I don't particularly recognise. I would say the main issue here is that we've had a very conservative approach to how we invest our customers' money in pensions in the UK. We've had a real obsession and focus just on charges. And while charges is important, what's most important is the overall outcome for customers. And UK savers are missing out on the additional returns you can get from these types of investments. And that's what we're looking to address with future growth capital.
So the initial commitment is $1 billion. You're looking at potentially $20 billion. What is the longer-term opportunity here, and as you look out in the years ahead?
Yeah, so if you think at Phoenix Group, we're investing £280 billion on behalf of our 12 million customers. 1 in 5 adults in the UK are customers of Phoenix Group. As far as our defined contribution savings, which is the lion's share of that, are concerned, eventually we'd like to see 5% of that invested into these types of assets. So we've made an initial commitment of $1 billion right now to get it going. We've committed $2.5 billion over the next 2 or 3 years. And in reality, I'd like us to be doing more than that. But then we think Future Growth Capital will be an excellent vehicle for other pension funds to say, right, OK, I want an allocation to this. I want to do my part of Mansion House Compact. And this is a fantastic vehicle. In partnering with Schroders, they have fantastic capability in this space. But what the vehicle will also do is it will selectively choose other asset managers with different capabilities in different areas to get that very, very diversified range. It's hard to do.
There are private markets and there are private markets, Andy, and you've talked here a lot about startups. You did say it's important that you have a diversified range of sectors and vintages when you're looking at private markets. Do you feel that there's anything conceptually awkward about the appetite that we see for private markets right now? Does it tell us anything about the regulation and the rules we put around public markets, that private markets are quite as popular as they are?
I think, there's definitely a shift going on, and more businesses are moving private rather than public. There's also a lot of good work going on to make the public markets in the UK more attractive. We've made good progress on that journey, but there's more to be done. The Capital Markets Industry Task Force that I've been part of has had a key role to play in doing that. But if you sort of stand in the shoes of our customers, they don't particularly mind whether the company we're investing in to get a return for them is private or public. And by having this Future Growth Capital vehicle, we're able to make sure that our customers get the benefit of returns from all types of companies, whether they're public or private.
Andy, what's your assessment of what you've been hearing from the new Labour government, and what would you be urging them to prioritise in this space? So
we would identify 3 key things for our customers, and the dialogue we have with the new government on these topics is positive and constructive. So the first is that in the UK, the level of saving towards retirement, the default level of saving in automatic enrolment workplace pensions, is 8%. In Canada, the savers are saving on average 20%. In the UK, the employer contribution is 3% of that 8%. In Australia, that's 12%. So the number one is people aren't saving enough, and to allow people to carry on thinking saving 8% will be enough to give them a decent retirement is not good enough. We need to increase that level of saving. The second key thing is only 10% of the UK population get advice on the journey to and through retirement. 90% get very little help and support. And so the Advice and Guidance Review, which is in train, really does need to bring through ways in which far more people can get help and support on their journey to and through retirement. And then the third key thing we're focused on is very much in this space. So how can we deploy our customers' money, invest our customers' money to get them better returns, but but at the same time benefit the UK economy. So we'd like to see domestic investment incentivised within pensions, and we'd like to see businesses like Future Growth Capital flourish to give customers better returns and to benefit the UK economy.
How do you incentivise domestic investment, Andy, at the same time as making sure customers get the best possible results? Because is there some kind of conceptual conflict there that maybe the best opportunities are not domestic at any one time?
So we believe at Phoenix, we believe strongly that customers should have choice. There shouldn't be mandation in this. Customers should be able to choose where they want to invest their money. But what many other countries do is the tax breaks available on pensions would be greater. An incentive, it will be greater if people are investing in domestic assets rather than investing in overseas assets. So in the UK, our pensions industry invests roughly 5% into the UK, which is basically in line with global MSCI indices. Other countries would weight and incentivise to weight the investment more to their domestic market. So there's still complete customer choice, and we would always invest where is in the best interests of our customers, but we'd be likely to invest more into the UK if the tax breaks incentivise that, because we'd be likely to get better returns for our customers as a result.
OK, calling for a tax incentive there to encourage those domestic flows. Andy Briggs, Group Chief Executive Officer of Phoenix, thank you very much indeed for your time this Friday morning. Coming up, stocks to watch, including IAG, the British Airways parent, of course, the company which has abandoned its pursuit of Air Europa. We'll get the details and why they've done that. That's next. This is Bloomberg. Welcome back. Happy Friday. We are just over 15 minutes from the opening trade and looks set for a bruising Friday. Futures in Europe pointing lower by more than 1%. Nasdaq futures, of course, and the tech story, part of the misery across these equity markets right now, because Nasdaq futures slumped and continue to fall lower, of course, after Intel and Amazon earnings disappointed investors. Apple's revenue, however, did beat, and that's despite sluggish sales in the Chinese market. Apple blaming a stronger dollar for part of that softness in the Chinese market. Joining us for the details and a roundup of the earnings stories that crossed, of course, overnight stateside is Matt Bloxham from the Bloomberg intelligence team. Matt, let's start with the Intel story then. Wow, it was bad. And my question is are the wheels falling off in terms of Pat Gelsinger's attempts to turn this business around? I mean, what stood out to you, and is there a future path to growth for Intel?
Yeah, I mean, they're definitely on the wrong side of the AI story right now. And it's interesting because last quarter, I think people kind of felt that they were actually starting to kind of regain some momentum. You know, I guess the kind of big standout there was in the quarter, the really weak gross margin, which because they're kind of shifting some of their kind of production to a more expensive, near-term expensive facility. But obviously the kind of forward revenue outlook was really weak. So $12.5 to $13.5 billion for next quarter. The market was looking for $14 billion. You know, they're kind of caught in this limbo that, you know, most of their products are in the kind of old school non-AI world, and what they're doing on AI, particularly around the AI PC, just isn't coming through quickly enough. And all of the legacy stuff they do, particularly around servers, people like NVIDIA are developing products to kind of move into that market. So huge amounts of competition that they're really struggling to kind of find their rhythm with.
So they're falling behind in the AI race. We heard about AI from Apple, but that's really more about the promise of what's still to come with Apple Intelligence, as they like to call it, and the upgrade cycle. Is that where the excitement is, or was there comfort on China or comfort on iPads? What do you think was the message here? Yeah,
I think, I mean, obviously China was probably actually the kind of the negative read on Apple. But yeah, I think overall the fact that revenues grew at 5% rather than the 3 to 4 the market was looking at, and they gave a kind of similar outlook for the next quarter, another period of 5% growth. The market was looking for 4. So encouraging the revenue momentum is a bit better. That's partly due to iPad, and obviously, lots of positive commentary around how Apple Intelligence is going to support a stronger upgrade cycle with the iPhone 16 when it comes in September. And people have been kind of holding on to that since they first announced Apple Intelligence a month or two back. And I think that's really the big story. Certainly some of our own consumer research suggests that actually people aren't yet really excited about those features. So we'll have to see as they kind of get closer to that September launch timeframe, whether they can do enough marketing to kind of really get people excited about AI features on their next iPhone, and then that warrants a much bigger upgrade cycle to boost revenue.
Matt, thank you very much. Matt Bloxham from Bloomberg Intelligence with the latest on those tech themes. Let's put all the market drivers in focus and talk about markets in 3 minutes. Our Markets Live executive editor, Mark Cudmore, joins us with thoughts. Mark, wow, let's talk about the markets in a few minutes then and think about where we are. We were just talking there about tech negativity, and that's part of the driver of the sort of meltdown we've seen through the Asian session. But the job story out the US, also part of that story. The Topics index closing down 6%, the biggest drop since 2016. Give us some of your thoughts on the scale of the selling we've seen through the Asia session.
Yeah, it's pretty momentous. We've seen the Topics index have the biggest two-day fall since the tsunami in 2011. It's the worst day for the banks part of the Topics since October 2008, in the middle of the financial crisis. So it's a really dramatic day in Asia. There are three kind of big elements going on globally here around this stocks meltdown at the moment. I think, for one, there's a real worry around tech. You just had Matt on there talking about this, and there's this idea that maybe the AI bubble is popping, and certainly the price action there is terrible. Now, that can be disconnected from the economic signal out there, because they've been trading in incredible multiples. They've been trading this really euphoric story for quite a while. So we could see that pop without it spread through the economy. But there are two other negatives out there. One is the idea that maybe the US really is going to recession. Maybe the economy is slowing much quicker than anticipated. I think the concerns around that are overblown, but certainly I understand why they're there, and I am nervous. And we go into non-farm payrolls, which will confirm that either way at the moment. And then the third element of the slowdown, which, going back to Japan, going back to the really intense pain there, is that there's this perception that central banks are making policy mistakes. Maybe the Fed's behind the curve. And what was the BOJ doing, finally hiking rates this week, just as we're kind of going into this rapid growth slowdown and other central banks are cutting rates? And it's that sudden kind of juxtaposition of going in the opposite direction that is really hurting the Japanese stock market really badly.
This is a nervous Mark Cudmore then. Look, you don't think the hard land is coming, but you're nervous, you're anxious about it. So the question as to whether or not the Fed is now behind the curve, and of course we heard from Bill Dudley and Mohamed El-Erian, but essentially making that case, and yet we expect the first cut in September. When it comes to the jobs data then, because that is such a crucial part of it, you heard from Jay Powell, what are you looking for in terms of non-farm payrolls? Wage softness or the overall that's kind of top-line number? How consequential would this data be, Mark?
So I think we've shifted the focus entirely from inflation to the jobs market. That's what this week has been about. And that's what we saw in the ISM yesterday. We had prices paid was high again, but we're not worried about inflation anymore. We're worried about those cracks in the employment market, the labor market. So I think, we're not going to suddenly care about the wages dynamic too much. Sure, as a secondary thing, we might get worried about stagflation if we continue to worry about growth. But it's going to be all around those headline numbers and the unemployment rate. Do we trigger the SAM rule? Do people get excited about that? Now, I personally think that yes, the jobs market's slowing, but from an extremely hot state. This does not look like a recessionary kind of jobs market just yet. Now, obviously, maybe it is going to go over the corner. It rarely looks like a recession just before it arrives. But I do have to say that, to me, the asymmetric risk going into today's jobs data is that we get a slightly strong print, and this panic we've seen this week about a hard landing and the Fed behind the curve will be thrown out the window, because you know what? We have not controlled the inflation genie if the economy is not going into recession.
OK, Mark, we'll look for clues then around that fear of a hard landing in the jobs report later. Thank you very much. Bloomberg Markets Live executive editor Mark Cudmore with his thoughts on the global economy and the market's response to it. Let us get a look at some of the stocks we're watching. Joe Easton from our equities team has a rundown. Joe, good morning.
Morning, Alice. We're starting with IAG, the owner of British Airways, giving us a couple of bits of news. Firstly, on the earnings, the revenue better than expected. The profits pretty much in line with what the market was looking for. But the bigger news, perhaps, is they're walking away from a deal to buy Air Europa, the Spanish-listed business that they've been trying to buy for a number of years. That's due to regulatory concerns around it getting approved. We can see IAG shares actually having a bit of a stagnation over the past year. The rebound post-COVID faltering, given concern around some of their fares potentially coming down. But as we can see from the analyst ratings, Wall Street is very much positive on this, 25 buy ratings, not a single sell among the street consensus on that one. So pretty positive in terms of analyst ratings. We're also looking at Pirelli today, the tyre maker, reporting better than expected margins, though their sales do look to be slowing slightly, and that is something that analysts have warned on over the past few months. On a 2-year, though, looking pretty good, up 36%. And this is another one that analysts really like. The street likes this one as well. Not a single sell on this stock either. Most of those, there we go on the screen, 11 buys. So Pirelli potentially going to be pleasing some of those analysts on the margins today. Finally, we're looking at chips. Intel slammed, as you were discussing with Matt earlier today. The company reporting a drop in sales, announcing that they will also cut jobs and also suspend quarterly dividend payments. And there's the drop on the screen, down 19%. Now, it's been a bit of a volatile week for the European chip makers, and this is the sector that could be impacted by Intel. A lot of them are suppliers. We saw a jump in the likes of ASML earlier in the week following news of potential easing of China and US relations in terms of restrictions there. But we saw a big sell-off in tech and the rest of the markets. As you've been discussing, keep an eye on chip makers today.
We certainly will. Thanks very much from our equities team, Joe Easton, with a rundown of some of the stocks then in focus. The broader story, I mean, we are now in correction on the topics. Some of the Japanese markets, there's a different dynamic, as Mark was pointing out. In Japan, we have that BOJ angle, what that's doing to the yen, and all that that's very Japanese specific. But the rest of it isn't Japanese specific. There's overlaid on top of that, there's a global concern then about where the cracks are in the labour market and the extent to which we're seeing those cracks.
The opinion piece put out by Bill Dudley a couple of weeks ago, calling for a cut this week from the Fed, seemed like an eccentric outlier at the time. But now the consensus seems to be coming around to the idea that maybe this is a Fed that is going to be acting too late and is going to be acting with less aggression than maybe these markets need. The economic data, as we've been talking about, is looking soft. We see what the non-farm payroll is in terms of later today, in terms of the details that come out. Mark Cumble saying, look, things are not that bad. The labour market is still holding up. And then there's the tech story falling away. Yes. China remains a challenge. The catalysts for upside for these markets are hard to find at this point.
Yeah, absolutely. So keeping an eye on the tech sector as a result of that as well. European futures do point lower. We'll be back with the market open for this Friday morning. This is Bloomberg. A few minutes to go until the opening trade. It's Friday, everybody. We are getting set for a negative session here in Europe this Friday morning. We've seen some markets in Asia go into correction territory. Yes, there are some Japanese-specific dynamics around that, but the broader nervousness around tech and the growth story, the jobs engine out of the United States, worth lingering on here in Europe. This is the preamble into today's session then. This is the European markets. We started to get nervous about the jobs story out of the US. A couple of data points adding to our uncertainty there, or showing those cracks. And we started to get that nervousness at the tail end of the European session yesterday and firmly into the US session. So the US didn't bounce later on in the day, worth noting. The thing that happened later on in the day is we got further tech earnings and not much positivity coming through there. There was some of the dynamics around Apple, but broadly speaking, the tech story was a pretty weak one, and particularly the Intel news. So how does all of that add up to what we're going to see in Europe this morning? Well, that concern around global growth and the US jobs market, concern around tech, all of that adding up to negativity this morning. FTSE futures down 0.8%. US futures, you can see, are also weaker. Euro Stoxx 50 futures down by 1.2%. So we brace then, Tom, for some negativity at the start of trade.
A couple of individual stocks to focus in on, and part of that ties into that tech story that you were outlining there, Anna, which is Intel, and the read across then to the European chip makers. Intel scrapping its dividend for the first time since 1992. It's been running a dividend, and it's cut that now because of the concerns that it is needing to play catch up. The outlook as well coming through from Intel less positive than the analysts had expected. IAG dropping a deal around Air Europa. They're going to take a approximately €50 million hit in terms of the termination fee, but it's a beat in terms of Pirelli with their earnings. So we watch that stock for the upside, Anna.
Absolutely, we'll watch all of that. Interesting to see how much of the tech story around Intel is idiosyncratic to them, but even away from that, there's nervousness around CapEx CapEx spending on AI from tech names. So tech in focus for both of those reasons. Let's have a look at where these European equity markets open up. And to the downside is the answer in the initial trade, down 0.1% or so, a couple of tenths of a percent on the FTSE 100, waiting for the other markets to open up. The read across from tech is sometimes a little awkward into the European session, but we'll see where that Intel news takes us, the Amazon story, the Apple story. We'll see whether that nervousness around the spending on AI, how that is expressed this morning. There we are, some real nervousness around the FTSE MIB then, down by nearly 2% on the Italian market this morning. The IBEX down by 0.8%. Yes, it's the tech narrative perhaps, but it's also the broader story around the jobs data out of the United States. Two data points yesterday that really started to coalesce around a pivot, as Mark Cudmore was telling us last hour, a pivot from concerns around inflation to concerns around growth and jobs. And that's very forward-looking, isn't it, Tom? Because we're going to go there later with the non-farm payrolls report. But for the moment, European stocks then following Asia firmly into the red.
Yeah, and you're actually seeing, what you're seeing is a bit of support, it seems, for the FTSE 100. It's down 0.5%. You compare that to the drop in the Italian FTSE MIB, down more than 2%. Some of that support, it seems, coming through for energy in terms of the listings here in the UK, given that oil is still above $80 a barrel. But on the technology story, it seems investors are expecting a clarion call of further growth from these big mega-cap tech stories and tech names. They have not had that. There has been the granularity, the detail, the nuance within those stories, and that is proving harder to navigate, it seems. In terms of your individual sectors, the biggest losses now coming down for the financial sector, losses of more than 2.5%, and a bank's also taking a big hit, down 1.7%, despite the fact we've seen some of the French names, for example, reporting better results, and here in the UK as well. Industrials also taking a big hit, down 1.5%. Every single sector, including the safe havens, or at least those that you may move into in a risk-off environment like utilities and healthcare, also down in the red now. Every single sector in negative territory in the first 2 minutes of this trading session.
Yeah, financial services is one of the worst performing, thinking about where nervousness around jobs goes, how quickly we get rate cuts. Maybe that's some of the thinking there. But interesting to see that UBS is one of the biggest movers to the downside this morning. Down by nearly 6%, the most in 16 months on that one. So we'll certainly keep an eye on there. On the upside, though, there are some financial names that are moving higher. I think I spotted AXA to the upside a moment ago. And, of course, we have had talk around, we have had that story around what they're doing with BNP Paribas to buy AXA's money manager in a €5.1 billion deal. That's what we were reporting yesterday and into this morning. So certainly this is a sector in focus, and we'll get more on that sector as we go through this morning's programme.
IAG, and we've been talking about that, the fact that they've scrapped their bid for Air Europa, being welcomed so far by these markets. You're seeing a gain there of a little over 3%. And then we've been talking about the semiconductor read across from the softness in terms of the outlook coming through from Intel, and a really challenging set of results from that company stateside. BE Semiconductor falling more than 6%. So there's the read across there as well. In terms of some of the industrial companies, ABB also taking a big hit. Of course, the industrials in terms of robot making and other components within that business. That company down 4.5%. Logitech as well within the tech component down 4.4%. So there's a hit there in terms of the financials, in terms of tech. And again, as we said, so far, every single sector in negative territory, and the FTSE 100 just down 0.4%, losing 37 points, but bigger losses coming through in Italy and Spain.
Let's get some perspective on these market moves then this morning, this negativity across stocks. Let's bring in Jeffrey Yu, a senior EMEA market strategist at BNY Mellon, for his thoughts on what we are witnessing right now. Negativity around stocks, just down 0.4% on the FTSE 100, but there's more pain elsewhere, and certainly banks, financial services and industrial goods and services seem to be the worst affected. Jeffrey, good morning.
Morning.
What do you make of this sell-off and the multiple drivers of it?
So I think the employment situation, the recession word, the R word, that certainly is coming through. We think that maybe this is slightly overdone for the time being, but again, it's all in the data. Every single central bank has said that they will take every single meeting at a time. If the data confirms their fears, their downside risks, then they will act as needed. But I think it's just the CapEx spending, as you mentioned earlier, and quite a few earnings reports have highlighted that consumer really is feeling the pinch right now. Look at UK, for example, the savings rates, we're back in double digits. That is almost unheard of if we strip out the pandemic era moves. And that is happening despite good wage growth. In the US and the UK, those supposedly high-spending economies. So clearly, households are cautious. That means corporates need to be cautious, and markets are now reacting accordingly.
OK, so we have cautious consumers, concern around capex spend at tech names. And what about these cracks in the labour market in the United States? It does seem as if it was a week where we pivoted, as our colleague Mark was saying earlier on, from being worried about inflation to being worried about jobs. I wonder, I feel like I've said that a few times, though, as if we've had a few false flags on that front. So what do we make of this data?
So firstly, on the manufacturing side of things, right, UK ultimately is the US is ultimately a services-driven economy. So that's where let's take things with a pinch of salt. And people have mentioned, public sector employment, that's still driving things as well. So we need to look at things on a holistic basis, which I'm sure that the Fed will be looking at as well. But are we going to run into a situation a bit like what's in Europe? Like, I think the ECB is actually not acting fast enough because their manufacturing sector, the Eurozone manufacturing sector, has been contracting for God knows how long now, that they're still saying, no, services inflation is high, service inflation high. But here's the difference. The Fed has a dual mandate. The Fed has an employment mandate as well. The ECB does not have that, so the Fed will be much more attuned to this.
And the irony within the ECB is that they're getting pressure, of course, from the Bundesbank saying, hold on, let's not forget about these inflation risks. And it's the German economy, of course, that's taking the biggest hit in terms of manufacturing. Is the Fed behind the curve? Is that now where you land when it comes to this Federal Reserve?
I don't think there's enough data to confirm that yet. But the Fed, I think they will be able to look at the labour market situation with respect to earnings. So I think if earnings today runs at 0.3% sequential, 0.4% sequential, for example, how do they square that circle? If they need to focus more on their employment mandate and then pivot accordingly as well, right, then they can sort of catch up to some extent. But I think they need another, say, 2 or 3 more inflation labour market prints to confirm that. Whereas for the Bank of England, for example, which doesn't have good labour market data, full stop, right? They've acknowledged that outright. I think they don't want to be behind the curve, so they're moving early because they don't want to find out that actually the labour market's in a much worse state when they get the data.
Can we linger maybe on some of the tech nervousness then? Because I mentioned earlier the read across from US tech into Europe is sometimes a little awkward. It does not seem awkward this morning. Right. It seems quite obvious. Yep. So we have ASM International shares falling as much as 11%. BE Semiconductor dropping 7% out of the gates this morning. ASML shares halted in Amsterdam. This giant of the tech world halted. What read across should we take from Intel, for example? Is that quite an idiosyncratic Intel story about them being behind the curve on AI? Or does this tell us something broader?
I think the broader issue is profitability going to be as strong as the perfection, so to speak, and that was expected at certain points over the last year. Now, this is a sector, which, for a point, markets had thought that demand would not be price sensitive at all. So that's where we always tread into somewhat dangerous territory. If you think something's just going to go parabolic forever, it doesn't. There's always gravity to come into play. And I think companies, they are just not seeing, as the ISM, again, the new orders side of things, as a broader reflection of where CapEx is. So if that investment is not going to be there because final demand is not going to be there, I think that adjustment is taking place accordingly. There's always going to be hiccups along what is going to be a growth story. I'm fully on board with that, but we just can't be priced for perfection as we were perhaps a few months ago.
So I wonder how we think about carving out different names within tech then, because one of the key concerns for investors clearly has been how much money Meta and Microsoft and Amazon are spending. Right. And they've all recommitted in these earnings to continue to spend into 2025, most of them at higher rates from the CapEx that we're seeing right now on a quarterly basis around AI infrastructure. Right. So the beneficiaries clearly remain NVIDIA and to some extent AMD as well. So I wonder, the volatility in NVIDIA this week has been pronounced. You don't have to give us names, right, Jeffrey, but in terms of how you want to be positioned across the tech space then, given some of the downstream and upstream parts of this story.
So I think you want to move along the growth curve there. So you mentioned infrastructure, for example. That I still think is going to be medium to longer term story. You want the infrastructure to be in place when the cycle turns towards the upside again. So I think, that's where some adjustment needs to take. If, however, on a discretionary basis, because right now, going back to wage growth, going back to consumer, if discretionary spending, that is going to be a bit softer, especially on the services element. I think that's where in the tech space and the communication services space, we could struggle a bit. But the long-term growth element, this arms race almost for chips, for superiority, for investment. If you look at what China is doing right now, they're still, trying to move forward with this high-quality growth as much as possible. And in some sense, I wonder, are Western companies a bit worried about that crowding out of that space? They're going to face competition as well. So that's going to impact margins too. So even though demand is strong, don't assume that you have a natural monopoly over things. So I believe in the infrastructure story, but right now anything discretionary, especially on the consumer side, that's going to soften a bit.
And thinking about the tech infrastructure story, do you think investors will continue to have patience, to Tom's point, have patience for businesses that want to spend through the cycle? So if we enter a sort of cyclical weak spot, but there's still the structural story there to invest in data centres, invest in AI, will that continue to have momentum despite cyclical weakness?
I don't think so. From investors' point of view, they don't want to see the no-holds-barred growth, the spending that I think had sort of been priced in the past. But at the same time, they don't want to see just a sudden swerve, a turnaround in expectations either, because this is going to be the future and this is going to be a strategic element. Let's not forget that, especially with geopolitics driving things right now. There's going to be government impetus with governments. At the end of the day, they are big investors in this as well. They don't want to see innovation fall behind. So I think that's where private public sector funding will be in place, especially in the West. They want to be left out. But right now, for areas where perhaps spending can be pulled back and some discipline in particular with regard to costs, that needs to come through. But I think that's something the market will exert.
So on the hardware story, if you've been desperate to get into some of these big names in the last few months, is this a buy the opportunity in terms of this dip?
Well, if you look at the ISM numbers right now, if we have another, let's say, few prints around 45 or so, then that's something a bit more structural, right? So in the shorter term. So I think we need 2 or 3 more prints to actually confirm things. Yeah.
What about the rates trajectory from here then, Jeffrey? We've talked about some of the cracks maybe in the data story out of the US and the extent we should dwell on them or not. Where do you sit then on where the Fed goes on rates, or what kind of frequency of rate cuts we're going to get from here?
25 beeps per quarter right now, I think, is the standard for the Fed, for the BOE, even the ECB, though I think the ECB does need to do more. Maybe some conservative cuts, coming through. Still hanging on to my euro lower trade, much lower trade in that respect. But from their point of view, they still need to look at their inflation mandate as well. So I think the Fed will be really worried about stagflation at this point, whereby if you have, let's say, a payrolls print at around 150,000 or so or lower, but then earnings prints like a 4% annualized handle, that's going to be quite a struggle. It's like the BOE right now. They are seeing services inflation still close to 6. If you look at the annualized print of the last 5 monthly services prints, we're running at close to high single digits, low double digits at this point in the UK, services inflation.
Yeah.
So that signals a growth story, but not necessarily a broader jobs story.
But the Fed has a dual mandate, unlike the Bank of England, doesn't it? So maybe we get more emphasis on the weakness in labour there.
Right. But productivity is higher in the US, and that's where the US is always can be counted on to resolve that stagflation issue for itself. But in Europe and the UK, I think that's in the Eurozone and UK, it's probably a different story. Yeah.
What's the currency you're most excited about at this point? I mean, what is the pound? The pound has seen some strength. The Swiss as a haven. You want to be
back
moving
to
into
some of the Swiss names that you mentioned earlier, especially in the financial exporters, the earnings translation is going to come off. Net interest margins, that's going to start coming off as well. Very sensitive to that aspect. And I don't think the SNB, it's going to be President Jordan's last meeting in September. After that, are we going to see a similar framework compared to what we've had in the past? So I don't think they are going to be as activist. So earnings translation in particular, I think that is going to be a weak spot. But our data, our flow data, positioning data shows clients are still underheld in Swiss francs. They're still underheld in yen. So, these are the 2 currencies I still want to see moving forward. So Euro Swiss lower, Dollar Swiss lower. I still think that's the path of the least resistance. OK, Dollar Swiss, Euro Swiss, and the fact that many out there are still not allocating to the Swissy and the yen. We've seen those moves, of course, pronounced in the Japanese currency this week, but from a low base, of course. Jeffrey Yu, Senior EMEA Market Strategist at BNY, always lucid with the insights on these markets. Let's check in on the Core 6 this Friday, then, on, of course, a very challenged day, more broadly, for these equity markets. And, of course, we have the names in there, like ASML, like Ferrari. And Ferrari was the only one, it's just flicked lower now, in positive territory. It came through some decent numbers towards the end of the day yesterday, but Ferrari now down 0.4%. Nestle on the consumer side, just down 0.1%, so showing a little bit more robust picture. But then in terms of the tech story in healthcare, Novo Nordisk, look at that, down almost 2%. LVMH on the luxury space, luxury again. The challenges of China have tied into the autos and the luxury names, of course, in the last few weeks and months. We're seeing that again in terms of the picture today. LVMH down 0.8%. ASML, look at that drop, down 6.6% in terms of that key maker of extreme ultraviolet lithography machines listed in the Netherlands, and that read across, of course, from the challenging picture coming through from Intel. So ASML taking a big hit, down 6%. Let's check in on some of the individual stocks and unpack some of these stories and bring in our equities reporter, Joe Easton. Joe.
So that stock, ASML, just opening, as you say, Tom. We had a delayed opening on that stock, just showing us the volatility. Traders couldn't get a price on that one. It was halted at the start of trading, but coming down now 6%. Bear in mind, it was down around 2 to 3% yesterday. So across 2 days, almost 10%. And we're also seeing BE Semi, ST Micro and Infineon, all the chip makers down. The broader move in tech lower. Also that slump in Intel. Apple also not looking great after the close yesterday. All of that weighing on the sector this morning. And we also want to check in on the banking stocks. That's the one I had my eye on yesterday. The Stocks Banks Index yesterday was down the most since March last year, when there was the mini banking crisis in the US. Seeing further declines. SocGen, UBS, Santander, ING, some of the movers at the moment. UBS was one of the biggest decliners on the Stock 600 this morning. All the issues around economic growth, around declining central bank rates coming in at the same time, weighing on margins. That is what potentially traders are pointing to at the moment. A really big move in both of those sectors. Over in Italy, meanwhile, breaking news on a report out of La Stampa. This is an Italian newspaper saying that the Italian government could be looking at potentially another windfall tax on energy, on banks, on insurers, on all of those sectors, in addition to what they imposed a couple of years ago. So we're seeing NL coming down. Also Generali, the big insurer, UniCredit and Banca Monte dei Paschi adding to the broader banking declines. Italy in focus, adding to that fury about some of those declines that we saw yesterday. Then we'll look over at some earnings, actually a bit of green on the screen finally, and put these into the context of the broader market decline. Actually, they probably would be bigger if it wasn't for the broader sell-off. So IAG coming up, announcing walking away from Air Europa takeover alongside earnings. Pirelli got some good margins on the tyre maker, and Salvatore Ferragamo, the maker of fancy shoes and handbags, that kind of thing. They've got some good numbers out of them as well, so they're up a little bit. And ENGIE in Paris, the French energy provider, boosting their forecast this morning. All of those finally giving us a bit of positivity on the screen. Also, we're going to check in on the asset manager deal, AXA and BNP Paribas asset manager business. These deal kind of coming through. They are in talks, not confirmed at the moment, but we do look to see a big merger in that sector. So that is a bit of positivity on AXA, at least. BNP Paribas coming down with the broader banking space. Finally, want to bring up Ferrari. You did mention it there, Tom. Actually, an upgrade over at Barclays, overweight on that one, and a 450 price target. A lot of upside, but take a look at the shares. They can't even get a boost given that market sell-off in Ferrari. But Ferrari gets an upgrade. I thought that would be higher. I was a little bit wrong on that one, but at least we do have a bit of positivity in terms of Ferrari this morning.
Well, the broader market not moving in their favour, is it? And just to underscore what, Joe, you were saying there about the banking sector, the energy sector, and fears around government action in Italy, the FTSE MIB is now down by just over 2%. Thanks to Joe Easton from our equities team for bringing us all of the stocks on the move this morning. Then coming up, we'll focus in on one of the names that Joe was mentioning there. AXA shares rise as the French insurer enters talks to sell its asset management unit to BNP Paribas for 5.1 billion euros. We'll go live to Paris for the latest. That's next. This is Bloomberg.
Welcome back to the opening trade. We are 21 minutes into today's session, and it is a challenge session right now across European stocks, down 1.6% after a bruising Asian session. Of course, futures in the US also pointing to, wow, heavy losses. NASDAQ futures. NASDAQ futures pointing lower by close to 2% right now. S&P E-minis also pointing lower by 1.2%. Recession concerns in the US. A tech sell-off, of course, amongst other factors weighing on these markets. Let's get to a deal, though, in terms of the French finance space. French insurer AXA is in the green this morning, one of the rare, bright sparks within this equity market. That's after BNP revealed it was in exclusive talks to buy its asset management unit for 5.1 billion euros. The move will create one of Europe's largest money managers. AXA CEO Thomas Buberl told Bloomberg about the deal earlier.
AXA Investment Managers is a story at AXA of 30 years of great success. But when you look, is it big enough to really serve our needs? The answer is clearly no. With BNP, we've got a partner that is very like-minded. We have decided to enter into exclusive negotiations to sell, to really create this strong European asset manager.
OK, for more, let's bring in Bloomberg's Alex Rajbandari from Paris with the details. Alex, then, how did this deal come about? We heard a bit there about the rationale behind this from AXA. Talk us through how this deal came about and what both sides hope to get out of it.
Well, good morning, Tom. There's been a lot of speculation around the fate of AXA Investment Managers in the past years. And the reason for that is really the scale. As the CEO said, it was not big enough to compete, in the asset management space. You need to be bigger so that you can request lower fees from asset owners. And it wasn't the case at AXA. And also, AXA has strong growth ambitions in the life insurance and savings sector. And the fact that they didn't have an asset manager that was big enough to compete was kind of a problem for them to support their growth ambitions.
And what are the benefits then for BNP Paribas? So what's in it for them?
Well, for BNP, again, scale is important. Now it becomes one of the biggest asset managers in Europe, behind Amundi and UBS only. So again, it's going to be able to attract more asset owners in Europe and elsewhere. There was something that was quite attractive for BNP within the AXA IM package. It's the private assets. AXA IM Alternatives is kind of a known franchise in that space, and it's kind of hot topic today in the asset management industry that is set to grow even more. And, the likes of BlackRock are kind of plowing a lot of money into that. So that's important for BNP because it's a leverage for future growth. As well, it comes with a steady stream of income for them because there's a long-term partnership within the deal that allows BNP to provide investment services to AXA for 15 years. So, it's kind of a long-term thing for them as well.
OK, so that's the rationale. And look, this is all very much in your wheelhouse, Alex. So when you take a step back, what is your assessment of what this deal means for the broader European asset management sector?
Well, consolidation is on. We have seen the bigger ones like Amundi scooping smaller asset managers. But this time it's two subscale yet sizable asset managers combining their strength to become one of the largest ones. We have known for years there was a lot of speculation about potential consolidation in the sector, but small teams know well their worth. They know they could be sold at a higher price, so there was not a lot of moves eventually. This is kind of a game changer, although, there's still a lot of room to grow for asset managers in Europe to catch up with the big names like BlackRock or the other ones from Wall Street.
Alex, thanks very much. Bloomberg's Alex Rajbandari with the latest on the consolidation within that French market. So just because the Olympics is on doesn't mean that French corporates aren't doing deals, Tom. Not everyone in France is distracted by the Olympics. Managing
to pull themselves away from the games was one of the CEOs of one of the banks that we were speaking to yesterday. Was it Crédit Agricole? I believe it was. And he was saying, OK, you've got me at the right time. In the morning, I'm free to focus on business. In the afternoon, I'm engaged with the Olympics. There's some great reporting out of the Wall Street Journal and our own reporters, of course, in terms of the enthusiasm that French spectators have suddenly appeared to found, despite the fact they were pretty sceptical.
With an opinion piece echoing those sentiments, saying they've gone from cynicism to embracing the games, which definitely chimes with my 2012 experience. I mean, it's been fabulous to have all this sport to watch, and it continues. So that is where we are. The market's front and centre, down by 1.6% this morning on the Stock 600. So we return to that shortly. We'll also get you an update on some of the geopolitical issues we're dealing with this morning. Coming up, President Biden greets Americans freed in the biggest Russian prisoner swap since the Cold War. Details next. This is Bloomberg.
This is the opening trade 30 minutes into today's session, and European stocks taking a big hit after Asian stocks had a, frankly, walloping in their session. US futures also pointing to significant downside, despite the fact that selling yesterday was pronounced. The Russell 2000 ending lower by more than 3% yesterday. European stocks right now, as a benchmark, down 1.4%. And the heaviest selling coming through for the tech sector, where names like ASM, BE Semiconductor, ASML, ST Micro and Infineon all down between 3 and, take this, 7%. ASM down 7.8%. ASML down 5.2%. And part of that is down, of course, to the read across from the softness in terms of the earnings story and deep concern about Intel's future as well. So European stocks deeply in the red this morning. Let's get the details in terms of how this is all unfolding across the tech sector, what the pain point is, and how we should be thinking about the next few days and weeks. And bring in, of course, Matt Bloxham from Bloomberg Intelligence. Matt, just talk to us about the read across to Europe and whether or not it's rational. Is this a broad-based selling that we're seeing, because it looks like that, or is there some real concern about the sustainability of profit margins and earnings for these companies going forward?
I think it's a mixture, although it's been obviously we saw a lot of broad-based buying of the whole AI story, and now it's broad-based selling because people are still trying to figure out who really are the winners and losers. I think there is a specific read across with Intel, though, because Intel yesterday guided to a 20% or more reduction in gross capex for this year and potentially lower next year too. And so that kind of had a direct feed through to people like ASMI, and it's clearly going to affect them. I think when you look at the kind of bigger picture of the tech results, what you're seeing is a lot of investment by the really big tech players in the AI platforms, but a lot of that goes to one or two very specific players like NVIDIA. And what we're seeing more broadly, and we heard this from Microchip yesterday, and we've heard it from lots of others, is that certain segments of the market that drive chip demand, like EVs, for example, in industrials, are proving to be weaker than expected. Inventory levels are building up again. So if you look at the second half here, we've seen a lot of it the last couple of days. Inventory levels are going to be high. Customers are going to be winding down their inventory levels. So that's going to slow down the pace of new order demand. And obviously on top of that, people have got growing concerns about the US economy. By far and away, the US economy is really, in terms of corporates, is what drives the kind of whole digital AI transformation story. And so if corporates are slowing down their investments in that technology transformation, that's going to feed through to a kind of slower evolution of the market too. And that ends up kind of dripping through all parts of the market.
So Matt, it's interesting. So you're describing there something kind of cyclical that relates to weakness in the US economy and the slowness we're seeing in autos and all of the various end markets there. And this is what we were trying to we were talking this through with Jeffrey Yu earlier on in the programme. To what extent will investors have patience, and they don't seem to have much this morning, have patience for businesses that want to continue to invest through that cyclical weakness? Because if the structural story around AI investment is still there, you could see reasons to do it. But would the market become overly sensitive to that?
Yeah, I mean, I guess we're seeing the market is overly sensitive to it, but that's maybe just because of how quickly the market has risen. I think you're right. I think there are clearly some big players that the market has complete confidence that continuing to invest is the right thing. So people like Amazon, Google, Meta, all these big players, they are dominant in their markets today, and if they don't continue to invest, they're not going to be dominant in the future. So it's kind of an essential investment. And there are clearly, some big players like NVIDIA, where people kind of see confidence, these business with strong market positions, and they're going to reinforce that. I think beyond that, there are more question marks about where some of the kind of more marginal players, we're seeing this a bit with Intel too, that, do they have the right strategy for the AI future? Have they been doing it quick enough? And can they kind of scrabble their way kind of out of a difficult spot? And I think that's the bigger question mark.
And what you've really brilliantly pointed out is that investors in the tech space have to do a lot more homework in terms of picking out the potential winners and picking out those who are more vulnerable. And you talk about the EV softness, the inventory story, the smartphone business that hasn't come back unless you're at premium level. There's all these details, granular details, whereas before the start of this year it was just buy the bunch. And so that's what you're breaking down for us, which I think is really important. As you look forward then, and I wonder to what extent some silver linings came through for Amazon, for example, around cloud, whereas that was a bit of a challenge for Microsoft and Alphabet. When you think about Amazon, because it has that touch point on the future around cloud, but also on the here and now of e-commerce, what is Amazon telling us?
Contrasting stories. So, the here and now on e-commerce is weaker than expected, partly because of things like the Olympics distracting people, partly because of the economic softness in the US. I think they said customers are looking for deals. And there's also some kind of Chinese rivals that are kind of encroaching into that e-commerce space too, which was a challenge for them. Yeah, and also on the flip side, AWS, Amazon Web Services, their big cloud business, the market leader, stronger than expected growth. Their kind of investments and their market position continues to be really good there. But unquestionably, their business will be impacted by a soft economic outlook, because if companies are investing less in technology or winding down inventory, then they're not going to be driving incremental demand in new capacity in data centers, whether they're Amazon Web Service data centers or somebody else's. So, that will undoubtedly affect maybe the near-term growth that they can expect.
Matt, thank you very much. Thanks for joining us once again. Matt Bloxham from Bloomberg Intelligence team. Now, we are seeing weakness across risk assets, concern around the growth story in the United States and in China, concern around where tech stocks go. Not much evidence that geopolitical concerns are to the fore when it comes to investors' thinking this morning. Let's dive into some of the geopolitical themes, though, that are lurking and need coverage. The Wall Street Journal reporter Evan Gershkovich is back in the United States after being freed in the biggest prisoner exchange between Russia and the West in decades. Gershkovich was released along with former Marine Paul Whelan and another journalist with dual Russian and US citizenship. The president and vice president greeted them as they arrived at Joint Base Andrews.
Toughest call on this one for other countries, because I asked them to do some things that were against their immediate self-interest, and really very difficult for them to do, particularly Germany and Slovenia. Slovenia came in at the last minute, and I tell you what, the chancellor was incredible. I don't buy this idea that you're going to let these people rot in jail because other people may be captured.
This is just an extraordinary testament to the importance of having a president who understands the power of diplomacy.
Let's get more on the story with Bloomberg's Russia economic and government editor, Greg Sullivan. Greg, good morning to you. So what do we know about the diplomatic effort that went into this and how long it took to bring it to a conclusion? Because there were a number of nations involved here.
That's correct. This was a multinational deal. It was in its size and scope. We really haven't seen something like this since the Cold War. So a huge effort that has been ongoing for months, really. We know that earlier this year, Putin said that intelligence agencies were meeting with each other. We know that the U.S. has been trying to bring home Gershkovich since he was originally detained in 2023. And in the case of Paul Whelan, that's been a multi-year effort. We know that the administration did try to get him included in the deal when WNBA star Brittany Griner was swapped. So really a lot of effort across a lot of different countries and a long time in the making.
How much of a win is this for Vladimir Putin, essentially? Because they have their people, assassins in some cases, arrested, and they go through the proper legal format with the transparency and evidence presented. They go through the court cases, and in these cases they've been found guilty and they are jailed. On the flip side, Russia just picks up a journalist, there's no evidence, and frankly many would say it was a sham trial. This is a win for Putin?
It certainly was. Vadim Krasikov, the Russian that came home that you're referring to, he was really key to the deal and pulling it off. There was a lot of reluctance from Germany to release him because, as you said, he was convicted in a trial. The murder that he pulled off was very brazen. But for Putin, he can basically use bringing Krasikov home as a signal to agents in the field that Russia has their back, that Russia will do what they need to take them home. And Putin was very pleased with this. This is the man that he wanted to bring home, and he was able to secure his release. It was truly key for the deal to actually go down. So for Putin, he's probably viewing this as a victory right now.
Where does this leave, Greg? Where does this leave broader Russia-US relations? Still in a poor state, I suggest. I would guess, because I mean you've still got Ukraine and Russia fighting on Ukrainian territory, and the US supplying the Ukrainian war effort. Does this tell us anything about the broader politics between the two?
That is a great question. U.S. and Russian relations are at a low point, probably the lowest since they've been since the Cold War because of Russia's invasion of Ukraine. But they had been deteriorating before that, and this is probably not a signal that they're going to improve that much. But what is significant here is that there is still some diplomacy in the realm of these prisoner exchanges, that there is contact over prisoner exchanges that happens, even when all the other relations, other realms have pretty much deteriorated. So I wouldn't look for a reapproachment between Russia and the U.S. at this point, but it is significant to see that they are still communicating in this one sphere.
OK, Bloomberg's Russia economic and government editor Greg Sullivan with the details on this historic moment in terms of this swap that we've seen, of course, between Russia and the US and some of its allies. Greg, thank you very much indeed. Up later as well on this story, former UK ambassador to Russia, Laurie Bristow, joins the Pulse, 9:30 a.m. UK time. So let's tune in for that as well, the reaction, of course, to what we're seeing in terms of that spy swap. Coming up, President Biden vowing more support for Israel as Iran and Hezbollah ratchet up their threats. We get the latest on the Middle East. That's next. This is Bloomberg.
Africa's mineral wealth offers a $1.6 trillion opportunity, and governments want to cash in. With near record copper prices, companies are restarting dormant mines. The host countries are demanding more of the proceeds. For the first time, the Democratic Republic of Congo has started directly selling its share of copper from joint ventures and is doing the same with cobalt. This means more revenue for Congo than going through the JVs. Meanwhile, neighbouring Zambia is setting up a state-owned metals trading company, competing directly with the likes of Glencore and Trafigura, as well as increasing its stakes in mines operating in the country. Such moves reflect a wider shift across the continent as governments seek greater economic benefits from their natural resource wealth.
Gone should be the days when Africa is just seen as a source of rock, soil, dust, being exported out of our continent.
Ghana aims to refine its lithium within its borders, earning more, while Botswana wants a bigger stake in diamond miner De Beers. Demand for critical minerals is set to soar in coming years. Bloomberg Intelligence sees global copper consumption increasing by 2 million tonnes by 2030 amid the green and AI booms. Africa is taking steps to ensure it gets a bigger share of these vast riches.
That was Bloomberg's Samuel Etienne there on the new steps African governments are taking to capitalise on their resource wealth. Now, let's move on to other stories this morning. President Joe Biden has promised Benjamin Netanyahu, quote, new defensive US military deployments as Israel faces fresh threats to avenge assassinations of Hamas and Hezbollah leaders. But the president also pressed the Israeli leader to move forward with ceasefire efforts. Joining us now to talk about these latest developments in the Middle East, Jane Kininmont, Policy and Impact Director at the European Leadership Network. Jane previously held roles with the Elders, Chatham House and The Economist, specialising in the Middle East and North Africa. Jane, nice to speak to you this morning. So let's start with the latest developments here. President Biden promising Netanyahu new defensive US military deployments. What do we think that could look like? What should we expect to see from the US in terms of its assistance here?
Well, it may refer partly to what the US did when Israel was recently attacked directly by Iranian missiles. They may well be thinking that Iran's retaliation could include more direct strikes on Israel. And when that happened before, Western intervention was key in protecting Israel. But at the same time, Biden has been sending the message that the assassination of Ismail Haniyeh was not positive, to say the least, for ceasefire talks. So it continues his strategy of offering Israel support on the one hand, but putting pressure on it on the other.
And what kind of response in terms of Israel having to defend itself from what, I suppose, is the next question, because we saw weekend attempted attacks on Israel the last time we were thinking about this. This time around, some people are making quite a big deal of the fact that the Hezbollah leader, Nasrallah, has talked about these killings of Hamas Hezbollah leaders as crossing a red line, but not calling for all-out war at this point. I mean, does that give us any comfort in terms of the level of escalation we're going to see?
To some extent. I mean, it's probably still safe to assume that the major players here do not want all-out war. But what's been happening for the past few months, and indeed slowly building for years before that, is that everyone's risk appetite is increasing, and they're trying to test the risk tolerance of their adversaries. So they're taking more and more risks. The mediators, including the US, seem to be struggling to restrain them, and there could be miscalculations that do result in a bigger war.
Is it your assessment, Jane, good morning, that we see a repeat of those direct attacks by Iran on Israeli territory, or do they attack via some of their proxies, like the Houthis, like Hezbollah, like Hamas? What are the options that Iranian leaders are likely looking at in terms of retaliation?
As you say, Iran has quite a few options. We also can't rule out that they might try assassination or terror attempts on Israeli targets abroad in third countries, although that would also get them into hot water with whatever third country was involved. At the same time, what we have seen since the October 7th and the onset of the Gaza war is that generally Iran does not want to go to war for Hamas. They will want to respond in some way because they won't want to be seen to be humiliated and not respond, but they will be calculating how can they avoid escalation. We don't see anyone de-escalating, but we do see all sides trying to keep some kind of lid on things.
How closely aligned are Hezbollah to the decision-making? They have the support in terms of weaponry and finance, clearly, from Iran. But in terms of the decision-making, to what extent are they autonomous? Because they are seen as the biggest threat in terms of those proxies.
They work very, very closely together, and Iran really pushed Hezbollah to help it in Syria during the war there. But at the same time, Hezbollah does have some autonomy. It does have its own interests. It has some of its own sources of finance. So it's not just getting money from Iran, but from Lebanese diaspora around the world. So they will be feeding into Iranian decision-making, not simply being controlled by Iran.
According to our reporting, we've seen intermediaries being used by the Biden administration to try to get messages to Iran, to Hezbollah, to the Houthis in Yemen as well. What does that look like, and what kind of role can they play?
So this administration has been very good at back-channeling. In some cases, it is deploying its own diplomats, such as the envoy Amos Hochstein, who often goes to Lebanon and has been trying to find ways to de-escalate between Israel and Hezbollah for months. They also work through regional leaders. So one of the important factors that does help some restraint is that most of the leaders in the region do not want to see a conflict, and many of them, whether they admit it or not, talk to both Iran and Israel. So countries like Saudi Arabia, Turkey, Qatar are trying to calm things down, but also some of them look weak as things are not calming down, and their de-escalation efforts are really wearing thin.
Yeah, we certainly want to get your views on where the ceasefire talks stand. But before that, in terms of the calculation of Israel, they seem to have this kind of Munich-style list of Hamas leaders, certainly, that they're going to go through and take out over time. And we've seen that come to play. And arguably, put aside what you think about the conflict, it's been a successful week for the intelligence agencies of Israel. Yes. The challenge to that is risking this conflagration. Israel would say this gives them a stronger hand in terms of negotiations. Where do you stand on that question?
Well, when they were assassinating the members of Black September after the Munich Olympics, they were not trying to negotiate with that group at the same time. And what has really bedeviled the ceasefire negotiations is that these have been taking place tactically with Hamas at the same time as the Israeli government is sworn to destroy the group. It's kind of amazing that talks can take place at all under such circumstances. But there are risks now, because Ismail Haniyeh was one of the most involved Hamas leaders with the ceasefire talks. There are some questions about whether Qatar will continue their role, because they have been saying, how can we mediate if some of the people that we're negotiating with are liable to be assassinated at any point? But we might see Egypt take up more of a role. There is still an overriding regional interest in getting a deal.
So you think the ceasefire talks are still viable? At least there's still an option. There is still the hope that maybe the ceasefire talks can make progress.
There aren't many other options. I mean, at the end of the day, there are things that Hamas wants out of negotiations. It does want some of the military pressure off it, and it still has the hostages being used as a bargaining chip.
So interesting to see that, and in another field of operation, President Biden using the end of his presidency before November to achieve things on prisoner swaps with Russia. And I wonder if, because he is not contesting this next election, whether that leaves room for him to engage more with this, and whether that is an area that is that a reason progress can perhaps be made.
It can be. I mean, he's been extremely engaged personally since October 7th
anyway, yeah.
now. And I think that, you know, he and this administration have got a strong interest in diplomacy, even with adversaries. We've seen them also offer nuclear arms control talks to Russia, even with the current state of affairs and the ongoing invasion of Ukraine. They're always looking for options for diplomacy. And that's also relevant to Iran. So something else happened yesterday. Iran brought back its former foreign minister, Zarif, who was one of the key champions of the nuclear deal with the US. He's now a new vice president in Iran, and he'll be looking to have some kind of contacts with the US.
OK, Jane, thank you very much. Thanks for joining us. Jane Kinnan-Mott from the European Leadership Network. Thank you to Jane for joining us, and we'll certainly keep an eye on developments in the Middle East through the weekend. Here's what we're watching for in markets, though, before that. 1:30 p.m. UK time, we'll get US jobs data, payrolls and unemployment. We'll get the latest take on what seem to be cracks emerging in the market, and we saw that certainly yesterday in some of the data. Then 3 p.m. UK time, US factory orders and durable goods. Later, we'll get numbers through from Exxon and from Chevron, so plenty of corporate data coming through. But right now, our focus then, Tom, turns to what we're seeing in markets and weakness in technology names here in Europe.
So technology taking an absolute shellacking right now in terms of the sectors across Europe. Part of that is down to what we saw in terms of the softness came through from Intel, a terrible set of results there, and also concerns as well coming through for Amazon. Apple, it was a little bit more mixed. But yes, the big chip makers, the likes of ASML and Infineon, ST Micro, also all taking big hits of between 3 to 7%, 8% on ASMI, which is currently down a little over 8%. So tech is taking a really big hit. We've also got a story around Italy. So the FTSE MIB is one of the biggest losers, is the biggest loser in terms of your main indexes, down 1.6%. And this is down to a story reported out by local media, La Stampa, suggesting that the Italian government may consider a possible levy on Italian banks and insurance companies. So the banking and finance sectors within Italy.
Yes, and so we're seeing that coming under pressure. It would be an extraordinary tax proposal. It's not ready to be discussed in Cabinet, so there's no sense of urgency in that this is coming imminently. And you're right, you pointed out earlier, Tom, when we were looking at this in a break, that, you know, haven't we been here before on the Italian story? And we certainly have. We've seen rumours, and we saw rumours last summer that something like this would happen. A year ago, the Italian government really surprising investors by proposing a windfall tax. That was just on the banking sector. So this seems to go further. But then they backtracked from that and watered down that law. So we are seeing investors sell first and ask questions later. But you wonder where this conversation goes from here.
You'd imagine there's some investors there saying, wringing their hands, saying, not now, not on a day like today, where you're seeing all these concerns about whether or not we're actually facing a hard landing, whether or not the Fed and other central banks are behind the curve, whether or not the tech story is now dissolving before our very eyes. We look ahead, of course, to non-farm payrolls later today after jobless claims came in higher than expected. We'll be looking at the wage components. Interestingly, expectations in terms of Bloomberg Economics is that average hourly earnings are expected to come in, the increase, 3.7%. That would be the least in 3 years. The top line number in terms of non-farm payroll expectations are 175,000, down quite significantly from above 200,000 in their most recent print. Unemployment, of course, that level will be scrutinised. 4.1% is the expectation. If you get much above that, though, that could add to the bets around treasuries.
And certainly this is adding to our understanding of the labour market, which we improved yesterday. We improved our understanding of the weaknesses in it, didn't we, over in the United States. A couple of data points weighing on sentiment around the growth story in the United States. Jobless claims, the worst since August 23. ISM manufacturing, the employment gauge, down at 43.4. All of that, yes, leading to risk-off sentiment in markets, including, as you say, a 7-day rally in treasuries, or adding the 7th day, the longest winning streak there for treasuries since early 2020. So another underscoring of the risk aversion that we're seeing across these markets. That is it for the opening trade. I'll be back with the pulse shortly. This is Bloomberg.